Hi, I'm Rick Schumacher with LBM Journal. I want to thank you for joining today's webinar, Maximize Your Business Value by Improving Operations. How much is your company worth? Having a realistic idea. Actually, that's wrong. That's from a previous one.
Must have been a previous one, yeah.
Oops, but it was a good one. Okay. So valuing your business, best practices for LBM dealers. Okay. How much is your company worth? Having a realistic idea of your company's value is critical if you're thinking of selling or beginning the succession planning process. In today's webinar, certified valuation analyst Sam Brownell will discuss considerations for your business valuation and the expectations of the valuation analyst. Sam will delve into various types of valuation, illustrating their use and importance through hypothetical examples drawn from real-life engagements. In this webinar, you will get a deeper understanding of how your business would be valued under a variety of scenarios. Sam Brownell, CVA, CFA, MBA, is founder and financial advisor at Stratus Wealth Advisors. And Stratus Wealth is also the sponsor of this webinar. Sam's been a financial pro since 2006 and formed Stratus Capital Management in July 2013, which has grown into Stratus Wealth Advisors to provide goals-based financial planning and investment management to individuals, families, and independent business owners. As the firm grew, an increasing number of independent business owners sought Sam's advice on their short and long-term planning needs, including valuation, tax strategy, business continuity planning, and succession planning. So in 2019, Sam obtained the CVA certification from the National Association of Certified Valuators and Analysts in order to better serve the valuation and succession planning needs of his clients. You can learn more about Stratus Wealth Advisors at stratuswealthadvisors.com. And by the way, I'm beginning the succession planning process myself, and I'm working with Sam. He really knows this stuff, is doing a great job for me. And if you're thinking about beginning the process and don't know where to start, I strongly encourage you to reach out to Sam. He's a good guy and he knows this stuff. Okay,
Appreciate
a couple
that.
details. You're welcome. A couple details before we get started. All attendees are muted, so you can hear us, but we can't hear you. If you're having technical issues, click the chat button at the bottom of the screen to send us a message, and we'll work to quickly address any problems. If you have questions for Sam, click the Q&A button at the bottom of the screen anytime during the presentation and type out your answer or your question. He'll address as many as possible at the end of the presentation. And lastly, we expect the webinar to be finished in about 30 to 40 minutes. We are recording it and we'll send the link of the recording to everyone who registered. Plus, it will be posted on lbmjournal.com. And with that, I turn it over to Sam.
Great. Thanks, Rick. And thanks to the team here at LBM Journal. We love working with you guys and looking forward to another good webinar here. So as Rick said, today we're going to be talking a little bit about the valuation process, both from what are the expectations, and that's really important because going into one of these engagements, knowing what it is that you are going to get out of it and how you work through the process is really, really important to getting a good value, a defensible value, and one that you understand and you can think about and you can talk to your other advisors about. So to help with that, we're also going to go in, as Rick said, and look at a couple different examples, because there are many different types of valuations, and understanding which one you need and why will be a big help to everybody on the call. So let's get started. Just a brief introduction. As Rick said, my name is Sam Brownell, and I am the owner and founder of Stratus Wealth Advisors. We work primarily in the LBM industry. We work primarily with independent dealers to help them transition their business, and we're completely agnostic as to how that happens. And we like to see the independents stay independent, and so we will look at internal transfers, we will look at external transfers, we'll look at competitors, we'll look at potential employee ownership options, whether that's an employee stock ownership plan, worker-owned cooperative. These are all great potential options and should be explored, and that's part of the succession planning process. And it does take time, and so starting early is very important. So to get started here, we just like to use this cartoon because it is important to get through your head that planning takes time and is important. Otherwise, you're pretty much just closing your eyes and throwing a dart and hoping that it comes in where you need it to. And so part of the planning process is determining what your business is worth And in our opinion, that's probably one of the most important pieces of the entire planning process. There are other very important pieces, your staff, your employees, your customers, making sure that everybody's comfortable, the business is going to run. But we have to know what it's worth, because if we can benchmark what the business is worth, then we can start thinking through things such as, what are the tax consequences? How do we pass this over? Is it in one lump sum or is it over a number of years? So all this stuff becomes very important. And that's the starting early. 3 to 5 years. 3 to 5 years is an ideal time frame to transition a business, because it does take that much time. Partially because there's a lot to do, but primarily because everybody is busy. And when you're busy and you can't put your full focus on one task, which is clear for any of us, then you need some time, and you need to build some time in so that you're not scrambling at the last second and going, geez, I don't really want to be here, or maybe a health issue comes up with a partner. These are things that we don't want to have happen. So that's where starting the process early with that valuation is key. So just some statistics here, and these are ones we like to bring up to show just how important it is to know the value of your business, right? And it is because a lot of independent business owners put a lot of money back into their business, and that's fine. That business tends to be the biggest asset that they have. However, it also tends to be how they're planning to fund their retirement. And so again, we need to know what the business is worth, because if we don't, we're going into retirement hoping, well, the yard across town sold for $5 million. I run my business about like that guy, or maybe I run it better than him. I know him. He doesn't do as good a job as me, so I should be worth more than that. Well, that's not a great way to make a plan, right? You're just kind of sticking your finger up in the wind and trying to hope that it's blowing in the direction that you need it to. So what do we actually need to know about evaluation? Okay, these are questions that if you're going to get a business valuation, you should be asking, or the person you are working with should be asking of you. And one of them is, what is the purpose? What is the purpose of the valuation? It could be for M&A. You could be selling to a competitor or to a larger roll-up. It could be for gifting. Could be because a partner unfortunately died. It could be because there's a dispute between shareholders. It could be because somebody retired, right? There are many different reasons, but number one is we have to know the purpose. If you don't know the purpose for the valuation, it's very difficult to actually come to the right value. And by that, I mean, if I'm selling to a third party, it's going to be different than if I'm gifting to my child, and we'll see more about that later, right? Type of value, right? We'll get into this too. This is equity versus enterprise value. Right? What are we calculating here, and why does it matter? Again, something we'll get into more detail. What is the date of the valuation? This is something that seems trivial. Well, date, why is that so important? Well, if we don't put a benchmark down, say December 31st, 2023, there are so many hypotheticals. Well, should we include this? Well, we're going to get those receivables next week. Oh, well, but we turned over our inventory a little bit fast. There are so many things out there that go into what your business is worth that we need to put a stick in the sand and say, we're going to do it right now, as of this date, because of these specific reasons. And we'll get into some of those reasons, but the date becomes really important. And then finally, discounts. And this is something that is important to know about, particularly if you are not doing a third-party transaction. Third-party transactions, we want to try to get the price and negotiate from the highest level we can. However, if this is for tax purposes, right, I'm gifting to a child or granting to a key employee, I want to try to keep that valuation lower. And so there are discounts that we can apply, and we'll talk about those. All right, what are the expectations of somebody in our position, right? The valuation analyst. All of these are key and really important to keep in mind, because our job is to be objective. And I'll give you a great example. We have folks come to us and will say, Sam, we need you to do a valuation. I'd like to pass the business on. I want the valuation to be as low as possible. Okay, that's great. I don't know how low it's going to be. I don't know what you have in your head, but we have to be objective because our valuations have to stand up to a potential audit. Right? If the IRS comes in and audits a transition of the business and they look at the valuation and they can tell that we're moving somewhere that was preordained, that's not good. Right? We have to be an objective arbiter of value. So that's really important to remember. Okay? Communication and transparency. There's always an NDA in place. Okay? That way we can communicate information. It is vital that we are able to communicate and get all of the information back and forth between the business to be valued and us as the valuator. Because if things are held back, and we understand there may be reasons, oh, we didn't have a good quarter, oh, we want to do it at this date because X, Y, and Z. We understand that, but at the end of the day, we want to make sure that the value is defensible. In order to make sure the value is defensible, we have to have all of the information. Okay. Now, really important. We learn about your business by looking at the history. What happened yesterday? How sustainable have your earnings been? What does your employee base look like? Who are your major vendors? Who are your major customers? But your business is valued forward-looking. If I am going to buy LBM Journal from Rick, I am not going to pay for what happened. I want to know what will happen. What cash flow can I expect from this business? So that's vital to understand, forward-looking. So the valuation date is important because that sets when the historical stop and when the projections start. But the projections are what's going to actually help us determine what your company's worth, because that's what I'm buying. I'm buying future cash flow. Okay. And finally, it's the ability to spend some time. Know that you're going to need to spend some time on this, right? Gathering documents, answering questions, having some strategic discussions, because this is a very involved process. When we come in, our job is to be a potential hypothetical buyer for your business. That means we are going to go through a due diligence process that is very similar to if you were going through the merger and acquisition process. We are going to turn over stones. We are going to ask questions that may be uncomfortable. And you have to be okay with that, because our goal is to ask and get answers to these hard questions before the actual buying process begins. Because you can think, if I'm a buyer, an actual buyer, every question I ask that either doesn't have a good answer or doesn't have an answer at all, I'm in my head reducing what I'm going to pay for this business. Because I'm not going to pay if I have to fix the collections process, right? I'm not going to pay if we're not managing our inventory, if we don't know what SKUs we have, right? These are things that are really important to get under control. So a little bit about the types of value, right? Equity value, that's the value to the business owner. If Rick and I own a business together and Rick wants to buy my shares, he's going to pay me equity value. If Rick and I own a business together and we're going to sell to ABC company, they're going to pay us enterprise value, right? And the enterprise value is the value of the business, its operating assets, and its debt. Okay, so a little bit different. And depending on the purpose of the valuation, it will depend on whether equity or enterprise value is calculated. So let's dive into a couple examples here. Here are 5 typical engagements, right, that we run across all the time. Okay, the first one we'll go through is called an initial conclusion of value. This is a baseline for succession planning. If we're going to put together a succession plan for a company, for your dealer, okay, for your LBM business, we are going to want to start with a valuation, because that valuation will allow us to figure out everything else. Regardless of whether you are selling to a third party, to your kids, to your employees, you will be paid equity value. You'll be paid equity value for your shares. Just like if you sold your shares of Apple, you would get paid what the equity of Apple was worth, not what the entire enterprise of the company was worth. Okay? Date of the valuation, end of the month for which we have the most recent financials. Okay? For a lot of folks, that's probably maybe end of third quarter, maybe end of October, but we need to know that we have good financials in place that we can cut off and say, okay, everything going forward from here We are projecting, right? That's the hypotheticals. That's the future cash flow that we're buying. All right, discounts. All private valuations, whether they are for external or internal use, will typically include some type of discount for lack of marketability. Now, it may not always be included, right? If you're negotiating with a third party to sell to that person, they may be putting those discounts on their side, but they're not going to come to you and say, hey, Rick, I'm discounting your business by 10%. But what these do is it's harder to transact a private business than a public business. If I want to sell Apple, take out my phone, click, sold. Depending on which broker I use, I may not even have to pay $1. If I'm selling a private business, there are costs to that. If I'm using an investment banker, that's a cost. It's going to take time to do this. So what's the opportunity cost of having that money not be invested somewhere else? Lawyers, accountants, valuation analysts, consultants, all these people will come into the process to make sure it is done right. Well, those are costs, and that's going to reduce the value of the company. The second one here is specific to what type of interest is being bought or sold. In a minority position, if Rick is offering me 20% of his company, that's great. However, I don't have any control over the strategic direction. If Rick wants to decide he's not doing publishing anymore and he wants to open up a farm, I'm not going to be able to vote him down. I can try to leave the company, but I'm not going to be able to get in there and control the actual decision-making process. So those shares are worth less. And so we can put discounts on those. And this becomes particularly important when we're talking about estate or gift taxing, granting. We'll get to that in a second. So, hypothetical example, folks we've worked with. Multi-generational business. Children, but they're not in the business. You've got an owner who's the primary contact for all of the customers, all of the vendors. The owners lots of time will handle the purchasing, right? And they don't want to give that up. And so if we have interest here internally, let's say from a child and a key employee, what do we do? How do we juggle these two things? How do we make this work? And so we need to know a value, and we need to know what interest we're valuing, and then we need to know what discounts, the date, all of these things come into play so that we can start the planning process. If we don't, if we have no idea whether that 20% interest is worth $500,000 or $2 million, we can't really do a whole lot of good, solid planning work. So next, buy-seller shareholder agreement. Let me be very, very clear. If you are a co-owner, if you have multiple owners in your business and you do not have a buy-seller shareholder agreement in place, or it has not been looked at since it was written 20 years ago, this is a vital part of making your business function well. Okay, this is going to cover things such as death, disability, divorce, personal bankruptcy, retirement, termination, whether for cause or not, right? And this is you're buying out the equity shares of a partner. And so equity value is what we're doing. The date, this can become really contentious, right? Because if I am the seller, I want to pick the date that's most favorable. I want the highest value. If I'm the buyer, I want to pick a date that's the lowest value, right? I don't want to pay more than I have to. And so what we always can tell people is if you're putting together one of these shareholder agreements, make it very clear. It is the date of the valuation is the month end immediately preceding the trigger event. If I retire from the business on December 7th, November 30th is the date we're going to use for the valuation. Okay. Also discounts. Be very careful here because it's very, very important to be specific about whether or not discounts are included. This can cause a lot of legal fights and headaches among folks because one party, the buyer, will want the discounts, the seller won't. Okay, so be very specific whether or not you want to include discounts. Okay, here's an example. We see this a lot. Okay, legal documents, you don't look at them until they're necessary and then they become vital. Life insurance, a lot of partners have life insurance on each other. But if your buy-sell agreement doesn't stipulate that you need to be updating this value every 1 to 3 years, I would make that change because otherwise you're probably underinsured. And what we see is that the business now It might have been, they each had $500,000. The business was worth $1 million 20 years ago. Now it's worth $6 million. That $500,000 isn't going to go very far to helping buy out the business. And that means that the business is going to need to support the buyout through cash flow. All right. And so you need to think about this. How can the life insurance be used? Is it a down payment? Is it collateral for a bank loan? Right? How are we going to get money to the family of the deceased partner? And how are we going to make sure that the surviving partner doesn't have a business that's going to sink? Now, we talked about this a little bit earlier. This is where discounts really come into play. And this is a state gift and or grant valuation. Now, the difference between a gift and a grant is whether or not the person is in your family, right? If I'm going to gift it to my son, I can do that. If I want to provide some shares to Rick, who is not a family member, I have to do a grant. Now, the primary difference between the two is a gift means that there's a lifetime exemption, right? It's probably close to 26, if not over 26 million for a couple that's married filing jointly right now. As long as I am gifting and I don't hit that 26 million, I may be able to gift my entire business to my kids without any tax consequences, as long as I'm reporting the gifts every year. With a grant, because it's not a family member, there's going to be tax associated with it. But if I am going to grant a $500,000 interest to Rick, he's going to pay taxes on that $500,000, but he's not going to owe me $500,000. Well, so let's say he owes me, what's the top tax bracket? 37%. So he's going to owe me 37% of $500,000, which is still quite a bit of money, but it's a lot less than $500,000. And so this is a way that owners can incentivize their key employees who might want to take over the business without having that employee have to come up with the entire value. And so again, we're talking equity value here. Shares are transacting. And this is where discounts really, really become important. Because if I am gifting 10, 20, 30% to a child, let's say, or granting to a key employee, I have an incentive to try to make that valuation as low as possible so that I can gift or grant more. All right. And keep that either within my estate tax exemption, right, my lifetime exemption, or to make sure that that key employee isn't paying a huge amount of taxes. And so this is where discounts become important. And this is where also we have to really think about how the discounts are calculated, because we don't want the IRS to come back to us and say, you purposely inflated the discounts to try to make this value as low as possible. So what we do typically in a succession planning engagement is we will put together that initial valuation, and then we'll do what's called a post-ownership cash flow analysis. How much money are you going to need out of the business for your post-ownership lifestyle? If it turns out that maybe you need 70% of the value of the business, great. We may be able to gift or grant 30%. And there you're moving money outside of your estate without the tax consequences falling on you as the owner, right? But this doesn't work in every scenario. And that's why it's really important to get that initial value and to tie it to this post-ownership cash flow analysis, because we need to know how much you need after you are out of the business. Okay, those two figures really help us do a lot of work and figure out how we're going to put this whole plan together. All right, transition scenarios. Once we go through and we do the initial valuation, then we set up that post-ownership cash flow analysis. Now it's a question of what are the options? What are your best options out there, right? And depending on who you're selling to, it could be equity or enterprise value, right? There's a competitor across town. They want to pick up some more value add. They don't do mill work, we do. All right. Well, that may be an enterprise calculation. I want to sell it to my key employees. I want to sell to an ESOP, right? An employee stock ownership plan. That's an equity calculation. So this allows us to do different calculations to figure out what you might get in any type of transaction. And that helps with negotiation. That helps with setting up the legal documents. And again, we need to date it. Month end, where we have the most recent financials, is the easiest thing to do. And we need to think about discounts. Okay, because discounts will play in here depending on what percentage of the business we're transitioning. Okay, so look at the top bullet and the sub bullets there. That's the possibilities, right? Let's say that your business has an internal sale to a family, sale to the broad-based employees in an ESOP or a co-op, or maybe you've got a really good EBITDA, right? Earnings before interest, taxes, depreciation, and amortization, which is a key when you're selling externally, right? That's what external buyers are going to look for. Greater than 3 million. That's very, very good. Even today, that's a very strong number. And so that's a great business that has lots of options, and they can take any one of them. But what the owner really needs to know is, what am I going to get out of each one of these, and how do they play in? You know, if I sell, maybe I'm a C corporation, if I sell to a third party, I'm going to get taxed twice, right? Both on the sale and on the distribution to myself. Maybe it's better to go, maybe I don't need all the money. Maybe I should go with the sale to the family member. If not, there are benefits of being a C corporation and selling to my employees through an ESOP or a worker-owned cooperative, right? There are tax benefits there. So planning out these scenarios allows you as the owner to make the best decision possible for your business. And then finally, and we do this often and generally in conjunction or previous to and engaging an investment banker, and that's a seller's or M&A valuation. And this is something that you can go and have an initial conversation with a buyer. Let's say that the yard across town is interested in buying up some of the other yards, and they see that their owners are getting older. We might put together a seller's valuation for you, and this will allow you to have a number that you can start negotiating from, or at least feel them out. Right? If we come up on a seller's valuation with $5 million, and the people across town want to offer you $4 million, well, you may know that they're not really serious, or they're just trying to lowball people. And that's the point of putting together one of these types of valuations. And so, you know, one of the things that helps in any type of seller's valuation is just, where's that EBITDA number, right? And what are you selling, right? If you're just selling sticks, that's a little bit harder, right? Those commodity-based businesses, it's going to be harder to get top dollar for them, especially now, right? But if you've got an EBITDA margin, right, which is your earnings before interest, taxes, depreciation, and amortization divided by revenue of 10% or more, that's generally a good place to be, all right? And finally, when you start thinking through these type of deals, are you willing to take some risk, right? 2-3 years ago, you know, cash, right? A lot of people were paying almost all in cash. Now they're going to want the buyer to take some risk, and that could actually help the price, right? If I'm selling to Rick and I'm willing to maybe roll some shares, right? I'm going to sell 90%, but I'm going to keep 10% in the new entity. Or maybe I'm going to finance the sale through future cash flow of the business. That might actually help the price. So let's just do a quick roundup here before we get to some Q&A. What gives your business value? You have to have sustainable earnings, right? And that's what everybody's calculating. When we calculate, we're looking at sustainable earnings, not earnings that were due to price spikes, but what volume increase are you actually doing year to year, and how is that driving your EBITDA dollars, your margin? What's your ratio of value add to commodity products? Again, and Rick and I were talking about this just before the webinar, is, are you an owner that is still running payroll and still involved in deciding about insurance? Or are you an owner that's thinking strategically about, where do we expand, and what type of technology do we need to get our customers? What's the home market looking like? Think about where you sit in the business, okay? Because it's much easier to sell a business where the owner is at the strategic level than one that's very, very involved in the business, and the business really is the owner. Okay, then you look at customer niches, also really important. Who do you sell to? How is that different from your competitors? And then depending on how you're going to sell the business, are you willing to take some risk? Okay. Finally, remember, it's always net value, right? If we value your business and we say it's worth 6 million, then we have to start considering things like taxes, fees you might pay if you were going to sell it, you know, let's just say to your lawyers and bankers and all these people. So we always do these analyses. Yes, first we get the headline number, but then we want to know, what's that net number? What are you going to walk away with? And this is where thinking through some non-traditional options like an ESOP or a worker-owned cooperative may be helpful depending on how your company is structured, right? It's particularly if you're a C corporation. So we're here to help. Please reach out, right? We're happy to do complimentary consultations with folks. So we know this is a really, really tricky process, and it's very specific, right? So even if you have a good accountant or a good corporate attorney, they may not specialize exactly in this type of work. And since you're only going to do it once, we might as well make sure we get it right and get you the value that you deserve. So with that, Rick, let's open up for questions.
Sounds good. We have a couple questions and we have one comment. First person said, great information. Thank you. This gives us a lot to think about as we begin this process. They want to know, the question for me, is LBM Journal for sale? And the answer is no, it's not for sale. But thanks for asking.
Yeah.
Okay. Okay, are some types of valuation engagements more expensive than others? For example, a gift valuation versus initial conclusion of value.
Yeah, that's an excellent question. So the short answer is yes. And what it will depend on in many cases is who the intended audience is. So if we're doing internal planning for your yard, that's not going to be as expensive because what we're doing is everything's internal. We're using these numbers to help craft the strategy for the future. If part of our strategy then becomes we're going to gift some shares to a child, then that becomes more complicated because of the fact that our audience at that point is the IRS. And so we not only have to come up with the value, provide a report for it, and in that report, which is typically anywhere from 60 to 90 pages, we have to defend every single decision, every single assumption that we make. And so that's a much more involved process. And so typically for a gift or estate tax valuation, it's gonna be more just because of the fact that we have to provide so much detail to the IRS so that we don't give them any wiggle room to come back and say, well, why did you use this discount, for example? Or we don't think that we think these cash flows are growing too slowly, or whatever the case may be. But we really have to get in there and be very specific with a gift or estate tax valuation. So those are typically more expensive than when you're looking at something like an initial conclusion of value.
Got it. Okay, is valuation always based on EBITDA, or there's ever done on an asset basis? For example, customer contracts, intellectual property, hard assets?
So great question. And there are typically three ways that we look at when we value business. One is asset based, right? It's what we call the adjusted net assets approach. And so we do look at the balance sheet. We try to understand what you have on the balance sheet and who you owe. And then the other two are more cash flow based, right? There's what's called a discounted cash flow approach, where we're looking at what are your projected future earnings. And then we have to discount that back to the present to account for the fact that the future is unknown and there are risks to that. And then there's EBITDA multiple, which is actually related to that risk or discount rate. But that's also based off of cash flow. And so typically what we do is we go through each one of those three. And then based on what we know about the business, what we know about the market, some combination of those will help determine what the actual value is of the business. And just for everybody to keep in mind out there, that adjusted net asset approach is typically going to set the floor, right? That's going to be the lowest of the values for a going concern operation. And the reason that a lot of M&A valuations, right, merger and acquisition, are done off of EBITDA is because what the buyer cares about is cash flow, right? They're buying your future cash flow, and they understand that, assets will fluctuate, but built into those assets and that intellectual property and your workforce, that's all going to drive cash flow. And so if that is what I want, then that's what I'm going to pay you for.
Got it. All right. If we have an idea of the value of our business, should we share that with you ahead of time? Will this skew your objectivity, or is it important for you to know what we have in our head already?
Yeah, that's a really good question, because a lot of people do have an idea, and it's great. I mean, the folks in this industry, they're smart. They read up, they want to know, and they want to know what they're getting into, and want to know what they're paying for. And through LBM Journal, you all provide a ton of really valuable resources on this topic. And so people may have an idea, and I think it is important for them to be honest and say, well, geez, I really think that, my business might be worth around 5 million. And it's not going to skew our objectivity. For better or for worse, we're there to either surprise you positively or negatively with this. But I do think it is important to share initially, because that also helps us to understand what you've got in your mind, and maybe what you're using as a benchmark for your planning. Maybe you're working with a financial advisor or something, and you're telling them 5 million when your business is really 3.5. And so that's important for us to know, because if we do come back with a different number, that might change what the planning process is for you.
Got it. Okay, we have a couple questions here about multiples of EBITDA that buyers are paying. These might be better questions for someone like John Wagner of First West, but I'll bring them up and maybe you'll have some answers.
Sure.
First, what multiple of EBITDA does a yard doing 600K sell to a third party?
Yeah, so typically there are breakdowns under a million, right, of EBITDA, 1 to 3 million, and then above 3 million, and that typically determines where multiples are. I would say that if you're under a million, historically you might have gotten around 4. Lately, from what I'm hearing from chats with guys like John Wagner, you might only sell for your net book value, right? Assets minus liabilities, just because the market isn't as strong as it was. Once you start getting up into the 1 to 3, probably mid 4s, you're gonna be a multiple of EBITDA, and then over 3, those are still the most marketable, and probably closer to 5, if not above 5 still at this point. But everything got skewed during the pandemic for a number of reasons, but the multiples also, because people were getting 6, 7 times, which just isn't typical. This is an industry that's typically 3.5 to 5 times, maybe 5.5 times at the upper end of EBITDA.
All right, and then the other question: what are the multiples that you're seeing, and how are they different between strategic buyers and private equity roll-ups? Is one paying more than the other?
Yeah, so that's actually a really good question. So during the pandemic in particular, your private equity firms had a lot of money sitting around, and so they were overpaying. What I would say, they were paying higher multiples than the strategic buyers. That's kind of converged a little bit as the private equity folks have put more cash to work, right? Because you have to remember that a private equity firm has its own exit strategy of probably 5 years. So when they're buying your business, they're also thinking about, well, okay, if I'm buying Rick's yard for 4.5 times, I can't just turn around and sell it for 4.5 times. I've got to sell it for 5 or 5.5 times. So, what's the strategy there, and how do they get out of it? And I think also playing into it was that, this was an essential industry, right? And there wasn't a lot of places to park money during the pandemic, and private equity gets pressure from their investors to say, you need to get into something, you need to get into something. All of a sudden they saw this industry they'd never considered growing at 20-30% a year, which is very unusual. And so they jumped in and they started paying without really understanding the industry. And so they did overpay. But now I think everybody's gotten a lot smarter. Their modeling has gotten a lot better, especially in terms of the difference between what is controllable. One of the things we always look at and ask when we work with a client is, what's your volume increase? Because if your volume increase, let's say, was 1% a year from 2020 to 2023, but your sales were up 50%, we're going to know that a lot of that sales increase was due to price, which is a factor that you can't control as a dealer. And so I think that becomes really important. And as the private equity buyers have become more sophisticated, you've seen the multiples that they're willing to pay converge a little bit more towards your, larger strategic buyers in the industry.
All right, and we're running nearly out of time, so we have time for one more question. I understand the responsibility of the business owner to provide a lot of documents and information during this process. While I can provide you with financial statements, this is not my area of expertise. If we use a CPA or other outside advisor, can we connect you with them directly after we start an engagement?
Yeah, no, that's a great question and a really good point, because lots of times that is the best way to do it. And so this is part of the reason we put an NDA in place, is so that everybody feels comfortable sharing this information. And if need be, we'll also sign an NDA with your if it's a third party, right? Excuse me, if it's a third party CPA or bookkeeper, that's critical, because we need to have them as part of the team, right? This really works well if it's a team, and then the owner can answer the operational and strategic questions, and whatever they need to refer us, they can refer us over to the CPA to answer the more technical financial questions. So yes, that's a great solution to the problem, is to get to somebody who knows that data.
All right. And we have one more. I know I said that was the last one, but this is a really good question. So one more.
Sure.
It makes sense that sustainable earnings are key to valuing a business. But what if your business experienced one bad year that's an anomaly, perhaps due to COVID or some other condition outside the company's control? Will one bad year sink the value of our business, even if we don't expect it to happen again?
Yeah, no, that's another really, really good question. And so by sustainable, we mean that there's a trend, right? And if you had a business where there was one bad year, or on the flip side, one or two good years, those are things that when we go through the valuation process, we go through this process called normalization. And what we do is we try to look objectively and say, was that due to the way the business is run, or was this due to some exogenous shock? And so if something is due to one of those exogenous shocks, then that is not going to have a huge impact on the value of your business, because we know that, hey, in your state, they shut everybody down for 2 months. So 2020 is not going to look as great as 21 or 22. And that's okay. What I would say to everybody out there is, it's a story. Part of this is storytelling. And if we can tell a good story, it makes a big difference. And so just like with that estate and gift tax, we need to be able to defend the valuation. And if we can go back and say, well, look, here are the reasons this happened, and here's how we have adjusted that, then it becomes much easier for a buyer to understand, A, and B, to consider that to be reasonable, as opposed to coming in and either not understanding the industry and knocking you for it, which not very many people would do, but also arguing that, hey, maybe this isn't sustainable. So it is important to bring that stuff up. It's important to talk it through so that we can have a good story to tell.
Got it. And that's it. We're out of time and we're out of questions. So Sam, this is awesome. Thank you again.
My pleasure.
And thanks everybody for joining us, and we will see you. We'll be doing another one of these in I think a couple months.
Yeah, you'll have another one in the new year. So in the meantime, happy holidays to everybody.
Yes, happy holidays. Have a good day. Goodbye.
All right, take care.